For decades, we were told the same fairy tale. The dollar is untouchable and eternal. Gold is an outdated, barbaric relic, interesting only to jewelers and eccentric collectors. And China, for all its manufacturing power, would never be able to break the Western financial architecture because it is too dependent on it. It was a beautiful, logical, and very convenient story that entire generations of investors and politicians believed in. But while the Western world was busy with self-admiration and internal political squabbles, tectonic shifts were occurring in the East that most people simply slept through. China spent more than 10 years not on loud statements from UN rostrums, but on quiet, methodical, and incredibly expensive work to create a parallel monetary system consisting of gold, the yuan, and a fundamentally new infrastructure that does not ask permission from Washington, London, or Brussels to conduct transactions. By the end of 2025, we became witnesses to an event that will likely be marked with a red marker in the textbooks of economic history. Indeed, China's official gold reserves exceeded the mark of approximately 2,300 tons, which is an absolute record for their entire modern history and symbolizes a cardinal pivot in the strategy of managing national wealth. In dollar terms, these are hundreds of billions, but now they do not lie in the form of digits on the servers of American banks, but are locked in heavy physical metal that is impossible to disconnect from the network. And the most alarming thing for the old system is that this is only the part that Beijing is ready to recognize officially, publishing reports for international organizations. Unofficial estimates by commodity market experts go much further, suggesting that real reserves may be many times larger. But we do not even need conspiracy theories or insider rumors here, because dry official figures alone already tell the whole story. Someone very influential is quietly changing the operating system of their national balance sheet from trust in U.S. government bonds to trust in physical gold. In this episode, we will not engage in fortune-telling on coffee grounds, but will analyze the facts. And by the end of this video, you will understand three fundamental things determining your financial future. First, we will study in detail the mechanics of exactly how China sees control over the world gold market without shouting about it at every corner and by using tools that Western financiers considered secondary. Second, we will analyze what this slow, methodical, and almost imperceptible takeover of real assets does to the status of the dollar, which for decades has been used to being the only adult in the room and dictating terms to the entire planet. And third, we will translate this macroeconomic abstraction into the language of your personal life to understand what this means for you. Sitting with your standard set of cash, bank deposits, maybe some stocks and a couple of index funds, and observing this slow motion change of who actually owns real money in this world. I warn you right away, there is one specific little-known mechanism created by China that absolutely does not look like a loud headline for the front pages of newspapers, but works like a most powerful financial lever aimed at the very heart of the dollar system. And no one explains this to retail investors because it sounds technically complex and boring, although in reality, it is the key to understanding the future. Let us start the dive with the most obvious question that suggests itself to any modern person. Why in the 21st century are we talking about gold at all? We live in a supposedly modern world of digital payment systems where money moves at the speed of light. In a world of algorithmic trading with artificial intelligence and fashionable green bonds. So why is the second largest economy of the planet, possessing advanced technologies, so obsessed with a piece of inert metal that brings no interest, pays no coupons, creates no cash flows, and does not engage in innovation? The answer to this question lies in the cynical nature of geopolitics, because real power deeply does not care about your convenient fintech app or the yield of your portfolio for the last quarter. Indeed, power at the level of states cares only about what a strategic opponent cannot freeze, delete, block, or devalue simply by pressing the print button on their press. And here is the essence of the problem that many investors ignore. After the events of 2014, after the massive upheavals of 2022, after every new wave of sanctions, strict capital controls, and the turning of access to the SWIFT system into an economic weapon, every large country outside the so-called Western Club began to ask itself the same simple but terrifying question. This question sounds like this: what will really happen to the reserves of our central bank, to the savings of our nation, if tomorrow we politically anger Washington? If your reserves, which you accumulated for decades by selling your resources and the labor of your people, lie mostly in dollars in American Treasury bonds and are located inside Western banking systems, then the answer to this question is extremely simple and cruel. This money ceases to be yours. It can be frozen, blocked for an indefinite period, or turned into a most powerful lever of pressure on you, forcing you to make disadvantageous decisions. But if your reserves are in physical gold, which is kept under your full control, in your own underground vaults, under the protection of your own army and special services, then the lever of pressure looks completely different, because such an asset has no counterparty, and you do not need someone's permission to own it. China understood this simple truth faster than all other major players, and instead of spending time complaining about the injustice of the world order during press conferences, they did something brutally simple and pragmatic. They began to buy all available physical gold they could reach. This process went on nonstop, and starting from November 2024, the Chinese central bank quietly, without extra noise, increased its gold reserves for 14 months in a row, pushing total global demand from central banks to multi-year highs, creating a situation of chronic deficit in the market. In September 2025 alone, China added about 15 tons of pure gold to its bins. And so you understand the scale. This is almost a quarter of all the gold bought by all the central banks of the world in that specific month, which speaks to an incredible concentration of efforts by one country. It is important to realize that this is not just standard portfolio diversification or insurance against inflation. This is a fundamental structural shift in the philosophy of capital accumulation, a transition from trust in the promises of other countries to trust in physical matter. At the same time, one should not imagine cinematic scenes where columns of armored trucks full of shiny bars enter the gates of Beijing's vaults every night in secret. As in the modern world, much of this happens at the level of complex accounting. Metal changes hands in the vaults of London or Switzerland. A redistribution of ownership rights to the bars occurs. Complex international swaps are carried out, but the end effect remains unchanged. This effect consists in the fact that more and more physical gold settles on the balance sheet of the People's Bank of China, is withdrawn from free circulation, and less real metal remains available for the rest of the planet, which inevitably changes the balance of supply and demand. And while they methodically buy out the market, something else is happening that is impossible to ignore. The price of gold literally explodes, reacting to this insatiable demand and general instability in the world. We have already seen with our own eyes how gold broke through all conceivable historical maximums, trading above $4,000 per ounce at the end of 2025. And leading analysts of the largest banks now talk about 5,000, not as some crazy fantasy of gold bugs, but as a completely likely scenario for the near future. Therefore, when you hear in the news that China has gold worth more than $300 billion, understand one important thing. This figure is not static. It moves along with the price. And every time the price of gold in dollars jumps up, Beijing's metal automatically becomes more expensive relative to its dollar reserves, increasing their financial independence without any effort on their part. Imagine this situation with a simple everyday example. You and your neighbor have wealth accumulated over long years, but you keep it in a regular savings account in a bank and in some reliable government bonds, while your neighbor, being more suspicious, keeps it in a mixture of bonds and a large pile of physical gold hidden in a safe. If your government starts printing more money, lowers interest rates, and inflates inflation to solve its budget problems, your savings melt with every year, losing their purchasing power. Your neighbor, of course, might also suffer regarding his bonds, but his gold deeply does not care about your local inflation. It simply revalues in your weakening money, preserving its real value. And in the end, he becomes richer relative to you. Now scale this situation. Replace you with the United States of America, replace your neighbor with China, and you will immediately see the essence of the problem that is now unfolding on the global arena. For decades, the standard model of behavior for major central banks was ridiculously simple. Keep most of your reserves in dollars and dollar assets, such as treasuries, because they have the highest liquidity. This is the recognized world standard, and it is convenient for international trade. Gold in this model was perceived as an old family relic that is nice to have somewhere in the basement for prestige, but it is definitely not the main asset for a modern economy. Then came a wave of powerful geopolitical shocks, sanctions, and asset freezes. And a quiet but completely obvious process began, which financiers call risk reduction, or, to put it more simply, moving away from the dollar system so as not to depend on the political will of one country. Dry statistics from the International Monetary Fund show that the dollar still dominates in world reserves. This is indisputable, but its share is slowly and steadily crawling down, while gold and other currencies are coming out of the shadows, taking the vacated spot. And in this slow sliding of the old system, China is not just another passive passenger watching what is happening from the window. China is actively trying to take over the steering wheel and direct this process into a direction favorable for itself. But here is the most cunning and non-obvious part of this strategy. It is not only about just stacking gold bars in piles and waiting for the world to change by itself. China is engaged in rebuilding the very plumbing of the world gold market, changing the pipes through which value flows and the faucets that regulate this flow. For most of modern financial history, if you wanted to set the world price of gold, you looked at 2 points on the map, London and New York, where the main exchanges are located. It was there, in London and New York, that the main game was played through paper contracts, futures, complex derivatives, and huge leverage. All these beautiful and dangerous toys of Western finance that allow trading gold you do not physically have. It was there that fair pricing supposedly lived, but China looked at this system and said, "This is cool for you, but what if we build our own independent system where the price signal is formed here and does not depend on the moods in London or on the COMEX exchange?" Thus, the Shanghai Gold Exchange appeared, and what is even more important, its international division. The Shanghai Gold Exchange International, or SGEI for short. SGEI is not some random local platform for internal speculators. It is a strategic project of state importance. It is designed as a global offshore hub for gold trading where transactions are denominated in yuan. And what is critically important, physical metal actually moves between the buyer and the seller. The trick that Beijing pulled off is cruel in its brilliant simplicity. This mechanism allows foreign players, large banks, and funds to trade gold for yuan, store it in special Chinese free trade zones, and move it freely without touching China's main capital account, which remains closed and strictly regulated. Translating into normal human language, this means you can use yuan to buy and store gold in China, but at the same time, your money is not considered as entering the internal economy of China, as would happen with classical investment flows, which removes a mass of bureaucratic restrictions. Thus, Beijing gets exactly what it wants. More people from countries use the yuan in international settlements, and more physical gold is physically located in its ecosystem. At the same time, it does not lose control over its own financial walls and does not open its economy to external shocks. Imagine a house surrounded by a double security fence. Inside the first highest fence is the internal financial system of China, which is strictly controlled by the state. Capital flows there are limited, and Beijing watches every door so that no one takes out anything extra. But between the first and the second fence, there is a spacious yard. This is the free trade zone. This is exactly where the SGI exchange lives. Foreign investors bring their gold and currency into this yard, trade them for yuan, keep their assets in the yard, and take them back out if they want. But Beijing can at any moment say, this is in fact not inside my house, my internal fence is still closed, and I am safe. Thus, they actively promote the use of their currency, the yuan, without fully opening their capital account and without exposing their economy to risks of speculative attacks from which many Asian countries suffered in the past. Now mix this mechanism with one more most important detail. China is the world's largest producer of gold, mining more of it from its subsoil than anyone else, and simultaneously one of the largest consumers of jewelry and investment bars. Most of the gold mined at mines in China remains inside the country. It does not leak to the international market, as happens in Russia, Australia, or South Africa. It settles inside. So you have a complete picture forming. Internal production that goes nowhere, systematic and aggressive buying of imported gold by the central bank, and a giant trading system with pricing in yuan that attracts metal from all over the world. You don't need to be a doctor of economic sciences to see where all this is going and what long-term trend is being laid here. Over time, more and more real-world trade in physical gold will orient itself toward Shanghai prices, reflecting real demand and supply rather than just on London quotes of paper futures. More and more transactions will be settled in yuan, and not just in dollars. And gold becomes an ideal bridge for countries that do not want to fully switch to the yuan, fearing Beijing's control, but also do not want to remain chained to the dollar, fearing Washington's sanctions. Think, for example, about a large exporter of energy resources from the Middle East who is tired of constant political directives from Washington. But they also do not trust Beijing 100%. As there are also their own political games there. Right now, the trade standard is this. You sell your oil for dollars, keep part of these dollars in U.S. government bonds, and hope that tomorrow no one will impose sanctions on you and block your accounts. The Chinese offer based on gold looks completely different and much more attractive for such countries. Sell your product to us, get paid in yuan, and right there, without leaving the cash register, park part of this value in physical gold on the Shanghai platform. Use it as a reliable collateral or simply as a store of value without touching the Western banking system. You don't necessarily have to love China or share its ideology. You just need to love the possibility of choice and financial security. And the presence of real choice is exactly what destroys any monopoly. even one as powerful as the dollar one. Now let us talk about the dollar itself, because around this topic exists a huge number of myths and speculations. People on the internet and on television love to throw around loud apocalyptic phrases like the crash of the dollar is tomorrow, the end of American hegemony, the death of fiat money. But most of this is just information noise intended to scare you and gather views. The real story is much more boring, more technical, slow. But because of this, it becomes much more dangerous for the current status quo. The dollar absolutely does not need to collapse in one day with a crash and dust to lose its exclusive power. It simply needs to become non-mandatory to stop being the only option. Right now, about 88% of all global currency transactions, still one way or another, involve the dollar, and most reserves of world central banks are still denominated in dollars. So no one will flip a switch tomorrow morning to instantly replace it. This is technically impossible, but what China is building with the help of gold, the yuan, and new infrastructure is the construction of a second lane on the global financial highway. Today, the main traffic of the world economy still goes along the dollar lane with toll booths called SWIFT, American Correspondent Banks, and Western regulators who can stop any car. China's goal is not to blow up this lane or arrange an accident on it, for they themselves partly depend on it. Its goal is to build a parallel alternative route where the toll booths are Chinese, the road signs are in yuan, and the concrete under the road is made of reliable gold reserves. The more economic trucks begin to use this second lane, even partially, even for a small portion of their cargo, the less absolute control the U.S. has left over world finances and the possibility to dictate its terms. And here is the most unpleasant lever for Washington. The more the U.S. uses its current control over the dollar system as a weapon, introducing sanctions and restrictions, the more motivation other countries have to change lanes and go to the alternative route that Beijing kindly provides. So, let us return from the heavens of geopolitics to earth, to your personal wallet, because many think that these are all games of great powers that do not concern them. You might think that this is all a distant drama of large institutions, but money in the world economy flows like water in communicating vessels. If you change the tilt of the entire financial system, the flow that reaches your personal bank account also inevitably changes, changing your purchasing power. When central banks buy record volumes of gold, emptying vaults, they do it not because some popular blogger shouted "buy gold" on Twitter or because it became fashionable. They do it because they possess insider information and understand. In a world of constantly growing government debt, financial repressions, and currencies turned into geopolitical weapons, gold is the last asset that deeply does not care what flag is printed on your passport and who is sitting in the White House right now. So what happens when China becomes one of the main architects of how gold is traded, how it is valued, and where it is stored? This means that one of the key safety valves of the global system, the possibility of exit from paper money into real metal, is increasingly located in a structure designed and controlled in Beijing rather than in Washington or London. And here is where it becomes truly scary for the long-term fate of the dollar. Imagine a future global crisis, not a small technical recession, but a real shock comparable to the Great Depression or the crisis of 2008. Debt panic, collapse of the bond market, or serious geopolitical escalation. In every such crisis, three things always happen without exception. People and corporations run in panic into safety. They want instant liquidity, and they want something that is not someone else's obligation that might not be fulfilled. Historically, flight to safety meant two things: buying U.S. government bonds and buying gold. Bonds gave yield and liquidity, and gold gave insurance against a complete collapse. Now imagine that in the next big crisis, gold turns out to be in the very center of the storm. Prices fly vertically upward. Physical supply of metal is limited. Shares of gold funds trade with strange markups, and buying a real bar becomes almost impossible. At this moment, a question arises. Who controls a huge chunk of world flows and reserves of physical gold? Answer: China. Suddenly, all those who for years laughed at gold as a barbaric relic realize a simple truth. At a critical moment, whoever has real bars in their hands has the real levers of pressure on the situation. And do not forget an important point. Beijing can present this story inside its country and on the international arena as it pleases, depending on its goals. If they want to increase trust in their financial system, they can proudly point to these giant gold reserves as irrefutable proof that the yuan is backed by something tangible and reliable, unlike the currencies of competitors. If they want to shake the dollar, they can start making official statements about alternative systems of international settlements and pricing for commodities in yuan plus gold, which will become a direct challenge to the petrodollar. And now here is a fishing rod for the future, a specific situation in which China does not even need to dump its trillions in U.S. government bonds or do something dramatic and destructive to harm the dollar. All they will really need to do at the right moment is to competently use their dominant position in gold and their new ready infrastructure to offer other countries an easier and safer life outside the shadow of the dollar. No explosions, no loud speeches from rostrums, just better, more profitable, and safer conditions for doing business that are impossible to refuse. Before we get to this scenario, let us analyze the mechanics of what is happening a bit more and in more detail, because the devil always lies in the details. Gold purchases by central banks in the last few years have been not just strong, they have been truly relentless, resembling a vacuum cleaner that takes all free supply from the market. For several quarters in a row, the demand of precisely the official sector, that is, states, was one of the key drivers pushing gold to new historical maximums, despite high interest rates that usually press on metal prices. And in this crowd of buyers, China is by no means alone, although it is the leader. Other countries that have weighty reasons not to trust the West think about various emerging markets, economies under sanctions, and even some traditional U.S. allies who simply do not like being lectured on how to live are quietly doing the same. They are diversifying their reserves away from the dollar and in many cases reallocating precisely into gold, creating a wide front of rejection of the old model. This process is not coordinated in some secret dark room with a red button where villains build plans to take over the world. No, it is coordinated by a much more powerful force, economic incentives and the instinct for self-preservation. When the very rules of the game openly tell you that your dollar savings can be at any moment frozen for political reasons, while your gold bars in your basement cannot, you don't need any international summit to decide what to do. You simply take the phone, call the operations department of your central bank, and tell the traders, buy more metal while it is in stock. And in this lies the beautiful irony of the situation. The more they buy, trying to secure themselves, the higher the price of the asset goes. The higher the price, the more attractive and reliable gold looks compared to devaluing fiat. The more attractive it looks, the more political cover and excuses central banks have to tell the public. We are simply following market signals and protecting national interests, continuing to buy even more. So where in this global scheme, as a regular private investor like you or me, you are told from all sides by financial consultants that diversification is just adding some fashionable emerging market stock fund to your portfolio. Maybe a bit of commercial real estate, maybe a couple % of cryptocurrency if you feel brave and modern. But true deep diversification, the kind that the most informed players, that is to say, central banks, are doing now, is much more primitive, reliable, and hard. This is a mass transition from paper promises to physical metal. China, with its officially declared more than 2,300 tons of gold and an even larger hidden ecosystem of internal reserves, is essentially openly saying to the whole world, we no longer trust the rules of the game that are not written by us. Therefore, we simply take our chips from the table and accumulate them here. Here, we need to clearly separate and destroy two popular myths that hinder the understanding of the situation. Myth number one, China wants to destroy the dollar tomorrow morning. No, this is total nonsense, and it would be economic suicide for Beijing itself. China still holds significant, simply colossal dollar reserves. It still massively exports its goods to markets that are completely tied to the dollar and still gains from global liquidity, the anchor of which is the U.S. financial system. They are pragmatists, not idiots, and they are not going to set fire to the buildings of the world economy while they themselves live in a luxury penthouse on the top floor of this building. Myth number two, China is harmless because the dollar is too big and powerful to fall. This is also incorrect and dangerously complacent. What Beijing actually wants to achieve is strategic variability. They don't need a single building from which there is no exit. They need a separate spare exit, a reliable fire escape, and ultimately their own tower nearby built under different fire safety rules. Gold in this metaphor is the concrete foundation under this fire escape that will withstand any load. Shanghai exchanges, such as SGEI, and payment systems based on the yuan, are reliable metal railings and emergency lighting that make the path safe. When enough people and countries start using this ladder, instead of the main elevator, the administration of the main building, that is to say, the dollar system, will lose its monopoly power to dictate living conditions to everyone. And this is a real existential danger for the U.S. Not a sudden crash like in a movie, but a slow, painful erosion of influence. Not a sudden fall from a cliff, but a gradual movement along an inclined plane when, year after year, a few more countries decide that they no longer need to keep 70% of their reserves in dollars and reduce the share, maybe first to 50%, then to 40%, then to 30%, and so on. Meanwhile, the share of gold in their reserves quietly, without extra noise, crawls up, replacing the falling dollar. And in some surprising way, the place where they buy, store, insure, and value this gold increasingly turns out to be not London or New York, but Chinese infrastructure. You don't need that cinematic moment when the announcer on TV declares that the dollar is dead. You will just one day wake up in a world where the dollar is just one of several large regional currencies, albeit an important one. And the main bridge between all of them is made of gold. And the toll for crossing this bridge is collected by China. We will talk about how China's gold strategy is inextricably linked with alternative payment systems, why record prices above even $5,000 per ounce change the psychology of entire governments, and most importantly, what a normal person can actually do with this information right now instead of just scrolling through the news feed in horror and misunderstanding. And then it will become even more interesting. I will lead you through a hypothetical but frighteningly realistic scenario where a future crisis forces countries to make a hard choice between staying in the fading universe of only the dollar or making a step into a new Chinese cycle backed by real gold. Many of them already hold one foot in this door, just haven't slammed it behind them yet. If your financial life is built on the naive assumption that the dollar will always be the cleanest shirt in the basket of dirty laundry, perhaps you should listen very carefully to the continuation before this laundry burns to the ground. If you are in the camp of friendly countries or represent a strategic interest for Beijing, the conditions for access to these resources may be quite soft and even preferential. But if you find yourself in the wrong geopolitical camp, the doors can slam shut just as quickly as they opened. This is exactly how power works in the real world when we remove the romantic husk of diplomatic rounds. This is not a scenario for movie villains where someone threatens to destroy the world with a laser. These are complex, multi-layered negotiations where all participants with polite smiles pretend that no blackmail exists. Although everyone at the table physically feels the cold calculation of the opponent. Before we turn this conversation into a sermon about the inevitable end of the world for all dollar holders, we must include critical thinking and be extremely honest realists about the other side of the coin. Because underestimating the United States is as fatal a mistake as ignoring China. America still has colossal trumps in its hands that cannot be discarded overnight. They have the deepest and most liquid capital markets on earth where trillions can be parked without crashing the price of the asset. They have a legal framework that, for all its obvious flaws and politicization, still remains more predictable and transparent than in many alternative jurisdictions. One should not forget the global military umbrella, the network effect of decades of absolute dominance and most powerful institutional inertia. After all, people and corporations tend to hold on to what they know and understand. All these fundamental strengths will not vanish into thin air just because China decided to buy more gold. And they will not evaporate only because the BRICS countries hold another conference and release a loud communique. These factors work as a giant brake. They slow down the shift, make the transition process messy, volatile, and uneven. But here it is important to understand the difference between slowing down and stopping, because inertia can delay the inevitable, but cannot cancel the fundamental laws of economics. If you sit here as an individual investor and rely on the word slowly as your only safety plan, hoping that the old system will last for your lifetime, then I must disappoint you. That is not a plan, that is just a hope, and hope is a bad strategy in financial markets. Let us translate this conversation into the plane of personal responsibility and make it extremely simple and practical, because you cannot rebuild the world monetary system sitting in your kitchen, and you cannot design a new version of the SIPS payment system from your living room. But what you can really do is stop behaving as if the last 50 years of relative calm are the only possible version of reality. The healthiest way to think about your financial life in an era of change is to imagine it as a three-layered structure, where each layer performs its unique task of protecting your well-being. The first layer is your operational set for daily survival and functioning. Local currency, current bank account, debit card for purchases in a store, and some cash in case of technical failures. This level is absolutely necessary to live in society, but you must realize that it is completely open and vulnerable before your government, your banking system, and whatever mood the head of your central bank wakes up in tomorrow. The second layer is your standard investment portfolio, which includes stocks of companies, government or corporate bonds, mutual funds, exchange-traded funds, not EFs, possibly some income-producing real estate, or a pension plan. All these instruments hold on to the basic assumption that the current global system, with the dollar as an anchor, with working debt markets and predictable rules, will more or less stand and continue to generate profit. But there is also a third layer about which almost no one teaches you in business schools or on financial literacy courses because it contradicts the idea of endless consumption. This is your layer of systemic hedge, your personal insurance against catastrophe. This includes assets that do not depend on the health of one specific banking system, on the honesty of one government, or on the purchasing power of one currency. This is physical gold that you can hold in your hands. This is cash foreign currency outside your internal banking system. These are possibly some digital assets if you understand the risks of high volatility or foreign real assets in other jurisdictions. Gold occupies a central place precisely in this third layer. And its role here is not to make you fabulously rich overnight, but to become your personal version of what world central banks have been quietly and methodically doing for more than 10 years. They are reallocating part of their critically important reserves into something that does not need someone's promise or a politician's signature to exist and have value. When you look at the charts and see how China, Russia, India, Brazil, Turkey, and a whole bunch of other countries steadily, quarter after quarter, build up their gold reserves, regardless of the current price on the exchange, understand that this is not market speculation in an attempt to earn a couple percent. This is buying fire insurance. And if you believe that people managing multi-billion and trillion-dollar state balances are stupid alarmists, and you are the only one who has discovered the secret of eternal prosperity, then you can safely ignore these signals. But if you allow even the slightest probability that they know a bit more than you about the risks of the system, perhaps their behavior deserves not just attention, but copying within the scale of your personal budget. You absolutely do not have to become a fanatical gold sectarian, bury bars in the backyard waiting for the apocalypse, or shout on internet forums that fiat money is dead. But to pretend that gold is just an outdated relic for old men in expensive suits, while world regulators hit historical records in its purchases, that is no longer healthy skepticism, but a dangerous self-induced blindness. Let us analyze the heavy emotional truth that many do not want to face. A huge number of people are stuck in a state of deep cognitive dissonance. On one hand, they see alarming headlines about endless printing of money, budget deficits, crises, sanction wars, the expansion of BRICS, and trends of de-dollarization. But on the other hand, their psyche desperately wants to believe that none of this global storm will really touch them, and their cozy little world will remain the same. Therefore, they repeat the same soothing phrase, like a mantra: the dollar has always survived. It survived all crises. It will survive again. Which, by logic, is equivalent to a tenant statement. My landlord has always been kind and generous. He will never raise the rent simply because he has the opportunity. But history and economics deeply do not care about your psychological comfort because reserve currencies always change over long historical stretches of time. Sometimes they fade slowly, like a sunset. Sometimes they collapse suddenly, but they never last forever. The Dutch guilder had its golden time. The British pound sterling had an era of world domination. And now the dollar is in its late middle age. It is still powerful, still dominant, but no longer invulnerable and no longer without alternative. And here is the main plot twist that many miss. China does not need to physically kill the dollar or destroy America. It simply needs to make sure that the dollar can no longer dictate terms to the entire world without meeting any resistance. Think about this through an analogy with a city where for years there existed only one internet provider. This monopolist could treat customers like trash, charge absurd prices, introduce hidden fees, and disconnect service to the undesirable because he knew you would pay anyway, as you simply had no choice. But then a second provider appears in the city, and even if his service initially works slower or the coverage is not as complete, the game for the monopolist is over forever. A monopoly dies not because the first company disappears from the market, but because for the first time in history, people get the opportunity to say no and go to a competitor. China is building exactly this second provider for world finances, where gold performs the role of a reliable backbone cable. The yuan is the client's settlement account and payment networks, bilateral trade deals, and new Shanghai exchanges are the routers and data centers of this new network. So what should be done practically, sitting at your laptop or with a phone in your hands, rather than in an office of the Ministry of Finance? First, you need to ruthlessly kill in yourself two lazy habits of thinking. The habit of treating the dollar as a force of nature, like gravity or oxygen, because it is not a physical constant, but a political, legal, and historical construct that has survived until now only because a sufficient number of people agreed to believe in this myth. The second harmful habit is to treat gold as a meme from Grandpa's war stories. If everyone from central banks to the largest pension funds is accumulating it, perhaps the joke is precisely on those who continue to ignore it and consider themselves smarter than the market. Based on this understanding, you must determine your personal rules of financial security. And perhaps you will come to the conclusion, I want at least 10 or 20% of my long-term savings, which I do not plan to spend tomorrow, to be in assets that do not depend on one currency or the banking system of one specific government. Exactly how you fill this protective block with physical gold, cash, foreign currency, foreign assets, or maybe even Bitcoin, if you are competent in matters of digital security, depends on your personal risk tolerance. But to leave this block empty while a map of world money is being redrawn before our eyes is not courage. It is voluntary consent to become a victim of circumstances. Now let us link this with what will inevitably happen inside the U.S. itself if the external privileges of the dollar are slowly but surely eroded. For decades, America could allow budget deficits that would instantly kill the economy of any other country and come out dry only because the world needed dollars and American treasuries like air for breathing international trade. If you are the issuer of the world reserve currency, people buy your debt not because they love your culture or politics, but because they simply have no other choice for parking liquidity. But if global demand for this debt weakens, even gradually, even by fractions of a percent a year, the price of bad financial behavior for the U.S. begins to grow rapidly. To attract buyers for your debt, interest rates must be higher, and higher rates mean higher debt servicing costs for the government itself, more stress for corporations accustomed to cheap money, and more pressure on over-leveraged households. We are not talking about America collapsing tomorrow and chaos starting on the streets. We are talking about the end of the era of free credit as a birthright. The U.S. certainly can still survive and remain a wealthy country, but their right to financial error is shrinking like shea green leather. And the more they abuse the system, using the dollar as a club, the more the system resists and seeks workarounds. You have already seen a preview of this scenario in the last cycle of rate hikes. Bond prices were routed. Safe government debt suddenly brought double-digit losses to investors upon revaluation, and vulnerabilities began to surface in the banking sector that no one bothered to test in calm times. Now add to this the fact that the U.S. is no longer the only shop in the global village where one can park reserves or settle trade. If there is a viable alternative, lane settlements in yuan, the gold infrastructure of Shanghai, agreements within the framework of BRICS, some capital, inevitably leaks there, even if in a thin stream, but it is a constant leak that over time washes away the foundation. We will focus on specific, logically verified scenarios of the future crisis, not on apocalyptic fantasies, but on direct continuations of those trends that have already been launched. We will imagine a world where gold steps over the mark of $5,000 and remains there not as a short-term peak, but as a new normal. And scenarios where the dollar faces a global test of trust, and suddenly the world does not run reflexively to Washington for salvation, but starts knocking on the doors of Beijing, even if it is politically unpleasant for them. We will talk about what will happen if the experiment of the BRICS countries with creating settlement instruments tied to gold moves from the stage of loud presentations to a truly working infrastructure for commodity trade. And what a regular person will feel when their own central bank is forced to choose between staying chained to one fading system or making a step into a new resource-backed cycle. In the end, a direct and honest question arises before us. Are you adjusting your personal finances as a person who understands this tectonic shift and is preparing for it? Or are you standing on the shore as an observer, waiting until the next wave of crisis explains the new reality to you in the most harsh and painful way? Imagine the world in 3 to 5 years, where gold no longer flirts with marks of 2,000 or 3,000, but confidently lives above $5,000 per ounce, periodically jumping even higher on any panic. This happens not because everyone suddenly fell in love with the yellow metal, but because of simple, ruthless mathematics. Buying by central banks continues. Physical supply is limited by geology, and distrust toward government debt forces a long line of countries to seek insurance from the same risks. In this world, economic news looks surreal. On one page, governments announce new massive stimuli and support packages, and on the other, bond markets quietly revolt, demanding higher and higher yields to digest this tsunami of new debt. In such a scenario, any specific shock, be it the fear of sovereign default in a large economy, another banking crisis due to bad loans, or geopolitical escalation, triggers the same pattern. Funds frantically reduce risks, households panic, and governments start calling each other in the middle of the night in search of liquidity. In this chaos, gold becomes something more than just an asset. It becomes a global scoreboard showing who has preserved real solvency, how much metal you have, where it is stored, under what laws, and who can freeze it. And it is precisely here that China's position turns from the position of a quiet accumulator into the position of a reluctant lender of last resort for certain parts of the world. Suppose you are a medium-sized country that tried to sit on 2 chairs, having reserves in dollars and euros and a little in gold. When a crisis hits, capital flees your country, the yield of your bonds skyrockets, the currency falls, and you go to your usual creditors at the IMF or the World Bank. But there, the terms of aid are always harsh, requiring unpopular reforms. And here you receive a cautious signal from Beijing about readiness to talk about new arrangements. After all, China has what you need: a huge pile of gold, a controlled banking system, and a trading machine you depend on. They can offer loans in yuan, access to swap lines, or even the use of gold as collateral. And the price of this aid on paper will not look ominous, but in fact, this will mean another step away from the dollar orbit toward the Chinese sphere of influence. This is exactly the nuclear option in slow motion. No fireworks and declarations of war, just deal by deal, crisis by crisis. where China enters with real influence amplified by gold, while the Western system is busy with internal problems. American politicians sooner or later will have to choose between two difficult paths: either to retreat, carry out painful reforms and try to stabilize the dollar through discipline, or double down on aggressive control, thereby accelerating the flight of other countries. And while governments solve these global tasks, the individual investor must conduct an audit of their life and honestly ask themselves, how many of my assets depend on one system, one currency, and one regime? If the answer is almost everything, then it is a red flag requiring immediate actions to create that very third layer of security. Ultimately, in periods of global monetary reset, only two types of people exist: those who prepared in advance, created reserves, and for some time looked like paranoids in the eyes of others, and those who one day wake up to see how inflation has gutted their purchasing power and sincerely swear that all this happened absolutely unexpectedly. Now, when the cards are open and the trends are obvious, you have the privilege of choice. You can be a spectator who hopes that they up there will figure it out. Or you can become a boring, cynical planner who takes responsibility for themselves and adapts to the new reality before it knocks on the door. The choice of who to be in this story, a prepared realist or a voluntary victim of circumstances, remains only yours.